thousands and thousands and thousands of transactions now over a close to 30-year track record, and billions and billions and billions of assets sold using it, okay, across all the states and about every asset you can think of.
Many of our audience members are either selling stabilized senior housing assets or exiting after years of ownership. So naturally, the question of legality and IRS scrutiny comes up. Can you explain that?
Absolutely. That's the most important question. In fact, there's three things. There's legality, there's controls, which we've already touched on, and then there's fees. Okay, so we'll start with legality. So the deferred sales trust is the most vetted capital gains tax deferral that typically you or your CPA has never heard of until you hear us on like a podcast or you check out our book, okay? All right, it's based upon IRC 453. Here's the good news, John. You have heard about IRC 453. And in fact, you know about it as a seller carryback. For example, if John has a Texas senior housing facility worth $20 million, and for example, if he owns it free and clear, and for example, if his depreciation is fully depreciated, he has zero basis. Just keep it real simple. Well, John can find Steve down the street, and Steve could give a $5 million down payment, and John could carry a note for $15 million. It's something that's very common and not as common for a number of reasons, mainly because now all of John's capital is tied to that old asset, and he has other properties he wants to build, other places he wants to invest. But he makes the deal because, you know, the bank's interest rates are, 6-7%, and the other guy would have paid, 18 or 17 million for it. So he takes 20 because he can carry the note. But guess what happens? The guy buys the property, doesn't know how to run it, and 1 or 2 years later, he's renegotiating anyways or missing payments, which forces John to do what? Pay or foreclose on him to take the property back, build it back up again, and now he's just, or write the note down as a loss. Like, this is the whole problem with the traditional 453 installment sale. However, that installment sale goes back over 100 years. Like, this is tried and true tax law. In fact, the same form, John, that we report an installment sale on, if you were to do that regular installment, is the same form that we report the DST installment sale. So think of us like a structured installment sale, right? Or a specialized installment sale. So that's the first thing to understand. Now let's talk about track record, okay? Thousands and thousands and thousands of transactions now over a close to 30-year track record, and billions and billions and billions of assets sold using it, okay? Across all the states and about every asset you can think of: public stock, private stock, real estate, dentists, optometrists, Bitcoin, primary luxury real estate, apartment buildings, car washes. We just did a billboard sale in California for $17 million. We just did an $8 million automotive sale up in Massachusetts. We did a $17 million land sale in Texas. We can go on and on about all the deals that are closing. And so that's really important to understand that this isn't something we're just trying for the first time. Hey, John, let's test this thing if it works out for you. No, this has already been proven. We've already proven the strategy, the structure. In fact, we've been tested about 30 times with the IRS. State and federal audits, promoter audits. We've had no changes, no findings on any of them. So we're batting 1,000 so far, legally speaking, through the IRS audits. Very important, okay? The tax attorneys, my business partner, who are the ones that do the lifetime audit defense, really important. That's included into it. So the track record is really perfect. I'll leave another story here to kind of bring this home, okay? Because a lot of people, they'll go to their CPA and they'll say, "Oh, Mr. CPA, I heard this podcast. Would you listen to it? This deferred sales trust." First of all, their CPA typically gets confused with what's called a Delaware statutory trust. Notice that they're both DSTs, and all of a sudden that they're like, "Well, it doesn't work for your business sale," or Delaware's, or and we can talk about pros and cons on that if you like in a minute. But they get it confused, and then the moment they go, "It's not that," then they go, "Wait, I haven't heard of that. What is that?" And the challenge becomes, John, if you work with your family practitioner, this is the best way to make sense of this, and he's giving your blood work for 15 years, and he's helped to refer you to specialists, and he's been there for your family, and you have this connection with him. You would think that if you have an ACL surgery, he'd at least hear about that unique way that ACL surgeon does it. In fact, I played basketball in college. I had 2 ACL surgeries. I signed my scholarship, and 2 weeks later, I blew my knee out. It was devastating, right? And I'll never forget that doctor giving me that knee test. Where they grab the knee and they kind of pull it up and down, and he's like, "You're okay. You're good. Don't worry about it. You'll be back in 2 weeks." And I was like thrilled because I just signed that scholarship and I'm all excited. I'm like, "I'll be back for the team. Rah, rah." My brother and all of his wisdom said, "Hey, Brett, get an MRI just in case." because this whole knee test, the doctors cannot see the inside of the knee. You need to get that. I've heard horror stories of people who came back too early, blew their knee out, and they're done for the rest of their career. So I go back to the doctor and say, Mr. Doctor, can I please get an MRI? I know it's probably fine. He goes, you're wasting your time. You can go get that, but you're wasting your time. Let me just sign this thing. He's shaking his head, and he's just, really, I think, kind of upset that I'm not trusting him, but I'm just kind of like being cautious. So I kind of sheepishly walk out of there with the referral and, get in the car and drive, you're going to drive 45 minutes to downtown, and this is in California, and you're going to, do all this stuff, and it's all expensive and blah, blah, blah. Okay, doctor, but I just want to be, just in case, I want to be safe. 2 weeks later, he gets the results back. And guess what, John? He calls me. He says, Brett, I said, oh, hey, doctor, how's it going? Yeah, I got your MRI back. I'm like, all right, how'd it go? I'm expecting him to say, all clear. You have a completely ruptured ACL. You need reconstructive surgery. Okay. And it was like the moment stood still, and all of the like emotion and all of the frustration and all of the like, just, I was completely shocked too, because I wanted to believe him. Right. And so the point of this is, too often we look at that family practitioner as the specialist. But when you have a 5, 10, 50, $100 million exit, and they've never done the surgery before, and they've never heard of it, the mistake is relying on their expertise for something they've never done, okay? Now, here's the reality. If you bring them to the call with us, and we sit down, and we have the discussions, and we explain the tax law, and we walk through the track record, and we show them how it works, and they sign the NDAs, 9 out of 10 join us. In fact, they send us all of their clients, and they're thrilled to see that someone has actually figured this out. In fact, the creator of this is a CPA. He is a tax attorney. He's a dual CPA tax attorney. He's a genius. He figured this out, okay? And I'm the guide or the person who helps to educate on the front end. I'm kind of like the nurse, okay? And we work on a conditional basis. And so I say that because the legality piece is really important, but I want to make sure people don't make the mistake of putting too much on their CPA, what the specialist CPA tax attorney can provide. And so that's the legal part. We also have, national law firms, third-party CPAs, big-time financial advisors. They all work with us. We are all in our network. One of them helped build PIMCO from $80 billion to $1.2 trillion. He and his legal team did a 2-year due diligence, and they're a part of our inner circle. They manage some of the biggest wealth in the world, so their name's a part of it. I mean, we have so many resources for the legal part.